The Unified Money Thesis, Bitcoin USD Fragmentation, and China's Commodity-Anchored e-CNY. Summary: Unified money is a single asset that natively performs store of value, medium of exchange, and unit of account functions with aligned settlement messaging and value storage layers, eliminating forced switching, rent extraction, and fragmentation. Gold achieved this in the analog era but failed at digital scale. The United States dollar abandoned it through its two-tier split, with Treasuries functioning as the primary store of value layer, while currency and deposits function as the medium of exchange and unit of account layer. Bitcoin revived the concept through immutable digital scarcity and verifiable settlement. China may be pursuing a competing sovereign version. Through the development of the e-CNY, ongoing commodity accumulation, and expanding trade infrastructure, it is possible to envision a yield-bearing digital currency integrated into a controllable monetary unit and potentially supported by transparent commodity anchors. This creates the defining monetary contest of the digital age: trustless hardness versus sovereign scale and commodity credibility, with China's trade dominance providing a potentially powerful adoption flywheel for its monetary infrastructure. Number 1. Introduction and definition. Money has always been the coordination technology of civilization. The most effective forms unify three core functions in one instrument: store of value, meaning reliable long-term holding; medium of exchange, meaning frictionless transfer; unit of account, meaning stable pricing and economic calculation. Unified money goes further. It aligns the settlement layer, meaning final and secure value transfer, with the messaging and transactional layer, meaning the speed and volume of daily use, so that economic actors do not waste energy constantly switching between separate instruments. This eliminates rent extraction at every interface and supports long-horizon planning, the kind required for cathedrals, infrastructure, scientific advancement, and multi-decade technological leaps. The digital age has revived this ancient ideal after a century of fragmentation. Two competing visions now appear to be emerging: Bitcoin's trustless, rules-based model and China's sovereign, programmable model. Understanding them requires revisiting history. Number 2. Historical benchmark: gold as analog unified money. For millennia, gold served as near unified money. Physical coins and bars functioned simultaneously as store of value because they were scarce and durable, medium of exchange because they were widely accepted, and unit of account because they served as the standard for contracts and accounting. Settlement was achieved through physical transfer or verifiable claims on gold. The monetary layers remained aligned in an analog world characterized by relatively low transaction velocity. Its fatal flaw emerged with industrialization and telecommunications. Gold's settlement layer, involving physical movement, assaying, and secure transport, could not match the explosive growth in messaging and transaction speed enabled by telegraphs, telephones, and eventually the Internet. This mismatch encouraged the growth of fractional reserve banking and ultimately culminated in the final detachment from gold in 1971. The analog unified money fragmented because settlement could no longer keep pace with civilization's growing communication and transactional demands. The lesson was clear: future unified money would need to be digital native at the base layer. Number 3. The USD failure mode: deliberate fragmentation. The post-1971 dollar system abandoned monetary unification by design. It operates as a two-tier structure. The store of value layer consists primarily of United States Treasuries and Federal Reserve reserves, which function as the preferred vehicle for long-term savings, collateral, and reserve accumulation. The medium of exchange and unit of account layer consists of circulating dollars and bank deposits used for everyday transactions and accounting. Every movement between saving and spending crosses this divide. This introduces fees, spreads, interest rate arbitrage, intermediation costs, and policy risk. Banks extract rents at the interface through credit creation and maturity transformation. The Federal Reserve's discretionary management introduces time inconsistency into the system. Promises of stability can eventually lead to inflation, financial repression, or changing monetary conditions. Recent debates surrounding the Clarity Act illustrate this tension. Much of the resistance to yield-bearing stablecoins can be interpreted as an attempt to prevent capital flight from the traditional deposit system and preserve the existing banking structure. Rather than reducing fragmentation, the debate highlights how deeply embedded the fragmentation has become. The result is chronic short-termism, recurring boom and bust cycles, and declining confidence in long-term monetary stability. This content is brought to you by Bobby Giggs. Promote your brand here and reach a wide audience across platforms like YouTube, Instagram, and Facebook. Follow the links in the description to get started. Number 4. Bitcoin's revival. Trustless digital unified money. Bitcoin restores unified money through code and consensus. Its 21 million hard cap and transparent halving schedule create predictable scarcity and establish a verifiable store of value. The blockchain provides native, immutable settlement that is global and final. Users can hold, send, and potentially price value within the same monetary system. Higher layer technologies such as Lightning aim to scale transactional throughput while preserving the integrity of the base layer. Unlike gold, Bitcoin's settlement layer is digital and capable of keeping pace with modern messaging velocity. Unlike fiat currency, it does not require trusted intermediaries or constant movement between separate monetary layers. The result is a monetary substrate optimized for patient capital and long-term coordination. In theory, this creates favorable conditions for ambitious projects requiring multi-decade planning horizons. Bitcoin is not without limitations. Volatility remains significant. Unit of account adoption remains limited. Political and regulatory resistance persists. Scaling continues to evolve. Yet despite these challenges, Bitcoin remains the strongest existing example of rules-based digital unified money. Number 5. China's sovereign counterpart, programmable and commodity-anchored e-CNY. China appears to be exploring a different path toward monetary unification. Several observable developments provide the basis for this interpretation. The e-CNY continues to expand as a sovereign digital currency infrastructure. Yield-bearing functionality has been introduced into parts of the system, bringing savings and transactional behavior closer together within a single digital framework. China has also continued accumulating gold reserves while strengthening its position across strategic commodity markets. Silver export restrictions, rare earth dominance, battery manufacturing leadership, energy infrastructure expansion, and growing influence across critical supply chains all contribute to a broader picture of resource-backed economic power. At the same time, China continues investing in cross-border payment systems, digital settlement infrastructure, and trade relationships across large portions of the developing world. These are observable actions. The possible destination is more speculative. One possible outcome is a sovereign form of unified money built around a programmable digital currency integrated with transparent reserve assets. Rather than relying solely on government bonds as the primary store of value layer, such a system could potentially combine transactional functionality, savings functionality, and reserve credibility within a single monetary framework. Commodity anchors such as gold, silver, rare earths, energy production, or other strategic assets could provide mechanisms for monitoring monetary discipline without requiring full convertibility. If reserve growth and monetary issuance were reported transparently, holders could potentially assess dilution risk directly. Such a system would represent unified money through authority and transparency rather than through decentralized rules. Whether this becomes China's actual destination remains uncertain. However, China's position as the top trading partner for much of the world creates a potentially powerful adoption flywheel. Trade partners already possess incentives to settle, save, and price increasing portions of economic activity within Chinese-led financial infrastructure. Number 6. The emerging contest and implications. We may now be witnessing the emergence of two competing models of unified money. Bitcoin represents trustless, immutable, decentralized hardness. It is optimized for individuals, institutions, and networks seeking neutrality, censorship resistance, and predictable monetary rules. China's e-CNY represents sovereign, programmable, potentially commodity-supported scale. It is optimized for state coordination, trade integration, and strategic economic planning. The implications are significant. A successful Chinese execution could accelerate de-dollarization across parts of the global south, by providing an alternative framework for trade, infrastructure financing, and long-horizon development. Bitcoin offers a parallel alternative, a politically neutral reserve asset outside the direct control of any single nation-state. The risks differ. Bitcoin faces adoption challenges, volatility, and regulatory uncertainty. China faces challenges related to debt, demographics, transparency, political discipline, and international trust. Yet both models attempt to solve the same underlying problem. How can store of value, medium of exchange, and unit of account functions be reunited within a single monetary substrate? Civilizationally, unified money in either form could reduce short-termism and strengthen society's ability to coordinate across decades rather than quarters. The eventual winners will influence savings behavior, capital allocation, technological progress, and geopolitical power for generations. Number 7, conclusion. The unified money thesis reframes the monetary debate. After gold's analog failure and fiat currency's deliberate fragmentation, digital technology has reopened the possibility of genuine monetary unification. Bitcoin offers one path rooted in cryptographic truth and decentralized rules. China may be pursuing another rooted in sovereign scale, digital infrastructure, and commodity credibility. Both seek to align monetary functions that have remained fragmented for more than half a century. Whether one prevails, both coexist, or an entirely different model emerges remains unknown. What is clear is that the search for unified money has resumed, and the outcome may shape not only the future of finance, but the future coordination capacity of civilization itself.